Hi, welcome back. Today we are looking at a moment that a lot of people in the metals world have been waiting for, and now it has actually happened. Gold has crossed $4,000 an ounce, and silver is holding strong above $55. At the same time, platinum and palladium, the two metals we usually group together under the name PGMs, are going through a small pullback. If you own any of these metals, or you have been thinking about getting into them, this is exactly the kind of moment you want to understand clearly, because headlines alone will not tell you what is really going on underneath the surface. Let's break this down and start with the big number everyone is talking about. Gold at $4,000 is not just a round number that looks nice on a chart. It represents a level that many long-term investors, central banks, and even casual savers have watched for years as a kind of psychological ceiling. When a market breaks through a level like that, it tends to draw in a new wave of attention. People who were not paying attention to gold before suddenly start asking questions. Financial news channels run more segments on it. Friends and coworkers start mentioning it in casual conversation. That kind of attention matters because markets are not only driven by spreadsheets and models, they are also driven by human psychology, and round numbers have a way of shaping how people feel about risk and opportunity. Now this is important because gold does not move on its own for no reason. Behind this rally sits a mix of forces that have been building for a while. Central banks around the world have continued adding gold to their reserves, a trend that has been running for several years now as countries look to diversify away from holding too much of their reserves in any single currency. At the same time, questions about government debt levels, persistent budget deficits, and the long-term value of paper currencies have kept a steady stream of investors looking toward gold as a store of value that does not depend on any single government's promises. Add in ongoing geopolitical tension in different parts of the world, and you get a combination of factors that naturally pushes money toward an asset that has served as a form of savings for thousands of years. Here's what this means for the average person watching this video. You do not need to be a professional trader to understand why gold crossing $4,000 is a meaningful event. Think about it this way. Gold has historically acted like an insurance policy for a portfolio. When confidence in paper currencies wavers, or when uncertainty rises, gold tends to hold its value or even increase, while other assets might struggle. Seeing it cross a major level like $4,000 is a signal that a broad segment of the market, not just a small group of enthusiasts, is currently leaning toward caution and looking for stability. But the real story today is not just gold by itself. It's what is happening with silver right alongside it. Silver has climbed above $55 an ounce and is holding that level with real strength. Now, if you have followed silver for any length of time, you know it has a reputation for being the more dramatic sibling of gold. It tends to move slower to get started, but once it moves, it often moves with more force in percentage terms. That is exactly what we are seeing play out right now. While gold has been building its rally over a longer stretch, silver appears to be catching up quickly, and in many ways confirming the strength we are seeing in the broader precious metals space. Let's talk about why silver behaves this way, because understanding this helps you make sense of the current move. Gold is used almost entirely as a monetary and store of value asset. People buy it to preserve wealth. Central banks hold it as a reserve asset, and it does not get consumed in industrial processes in any meaningful way. Silver is different. Yes, it carries that same monetary and store of value appeal, but on top of that, it is a heavily used industrial metal. It shows up in solar panel production, in electric vehicles, in semiconductors, and in a wide range of electronics. This dual identity means silver demand comes from two very different directions at the same time: investment demand from people seeking a hedge, and industrial demand from manufacturers who genuinely need the physical metal to build real products. Now here is where things get interesting. Because silver is used in industry, the available supply above ground that is easily accessible for investment purposes is comparatively smaller than people often assume. When investment demand rises sharply, as it is doing right now alongside gold's rally, it does not simply add to a giant idle pile of metal sitting around. Instead, it competes with the ongoing industrial demand that never really slows down. That tension between limited available supply and rising demand from multiple directions is a big part of why silver above $55 is such a significant development. It suggests the market is having to work harder to balance who gets the metal, savers who want to hold it, or manufacturers who need to use it. Let's shift now to platinum and palladium, because their current pullback tells its own part of the story. Unlike gold and silver, platinum and palladium are overwhelmingly industrial metals, with their largest use coming from the automotive sector, particularly in catalytic converters that help reduce vehicle emissions. Their prices tend to be more closely tied to factory activity, automotive production numbers, and specific supply situations in the handful of countries that produce most of the world's platinum and palladium, mainly South Africa and Russia. When these two metals pull back even while gold and silver are pushing higher, it is not necessarily a contradiction. It's actually a reflection of how differently these metals are wired. Gold and silver are responding to monetary and macroeconomic forces, things like currency concerns, interest rate expectations, and safe haven demand. Palladium are responding more to industrial and automotive-specific dynamics, which can move on a completely separate timeline. Think about it this way. Imagine 4 different students in the same class. 2 of them, gold and silver, are responding strongly to a school-wide announcement that affects everyone, something like a change in policy that impacts the whole student body. The other 2, platinum and palladium, are more focused on what is happening in their specific after-school clubs, which have their own separate schedules and their own separate news. All 4 students are in the same building, but they are not necessarily reacting to the same triggers at the same time. That is a simple way to understand why we can see gold and silver strength alongside a platinum and palladium pullback without one having to somehow prove the other wrong. Now let's talk about what this combination actually means for someone trying to make sense of the bigger picture. When gold and silver rise together while PGMs lag behind or pull back, it often points toward a market that is currently more focused on monetary concerns than on industrial or economic growth concerns. In other words, the current move looks less about excitement over booming factory output and car production and more about a broader search for stability and protection against currency and debt-related uncertainty. That distinction matters because it tells you something about the mood of the market right now, even if it does not tell you exactly what happens next. If you are finding this breakdown useful, take a second to hit that like button, and if you have not already, consider subscribing to the channel so future videos like this one land right in your feed. It genuinely helps the channel grow, and it costs you nothing, so no pressure either way, just something to think about as we keep going. Let's talk about the other side of this conversation too, because a responsible breakdown always has to include some balance. Just because gold and silver are showing strength right now does not mean the path forward is guaranteed to be smooth or straight up. Markets that move quickly in one direction can also experience sharp pullbacks or periods of consolidation, where prices move sideways for a while as the market digests the recent gains. Central bank policy decisions, unexpected economic data, or shifts in investor sentiment can all introduce volatility. Silver in particular has a well-earned reputation for larger price swings compared to gold, both on the way up and on the way down. So while the current strength is notable, it does not remove the reality that precious metals, like every other asset class, come with their own risks and their own periods of uncertainty. It's also worth remembering that platinum and palladium pulling back does not mean those metals have lost their long-term relevance. Automotive demand patterns shift with the broader economy, and technologies around emissions and vehicle production continue to evolve. A pullback in one part of the metals complex can simply be a normal part of how different assets rotate in and out of favor, depending on what is driving the broader market at any given time. Supply from major producing regions can also shift quickly due to mining disruptions, labor negotiations, or energy costs. And any of those factors could just as easily bring renewed attention back to platinum and palladium down the road, even if today's headlines are focused elsewhere. Another angle worth considering is how currency strength plays into all of this. Precious metals are priced in dollars around the world, so movements in the dollar itself can amplify or soften the moves we see in gold and silver. When the dollar weakens against other major currencies, it often takes fewer of those currencies to buy the same ounce of gold, which can add fuel to a rally that is already underway for other reasons. When the dollar strengthens, the opposite tends to happen, acting as a headwind, even if the underlying demand story for metals remains solid. Keeping an eye on the dollar alongside gold and silver prices can give you a fuller picture of what is actually driving the moves you are watching unfold. Now let's put together a simple mental framework that can help you follow this story going forward, without needing to check prices every single day. Picture the precious metals market as a table with 4 legs: gold, silver, platinum, and palladium. Gold represents the monetary leg, closely tied to currency confidence and safe haven demand. Silver sits in between, carrying both a monetary identity and an industrial identity, which is why it can sometimes lead and sometimes lag depending on what is driving the market. Platinum and palladium represent the more purely industrial legs, closely tied to automotive and manufacturing cycles. When you see all 4 legs moving together, it often signals a very broad, strong move across the entire commodity space. When you see a split, like we are seeing now, with gold and silver up while platinum and palladium ease back, it tells you the current move is being driven more by monetary and macroeconomic forces than by a broad industrial boom. Keeping this simple framework in mind can help you interpret future headlines without getting lost in the noise. Looking ahead, there are a few different ways this situation could unfold, and it is worth thinking about them without assuming any single outcome is certain. One possibility is that gold and silver continue to build on this strength if the underlying concerns around debt, currency stability, and geopolitical tension persist or intensify. In that scenario, $4,000 gold and $55 silver could end up looking like waypoints along a longer journey rather than final destinations. Another possibility is that we see a period of consolidation, where prices pause and trade within a range as the market absorbs these recent gains before deciding on a next direction. A third possibility involves platinum and palladium, eventually finding their own catalysts, perhaps tied to shifts in automotive production, supply disruptions from key producing countries, or changes in industrial demand, which could bring those 2 metals back into a stronger position relative to gold and silver. None of these outcomes is guaranteed, and it is completely normal for markets to surprise even experienced observers, which is exactly why staying informed and thinking in terms of possibilities, rather than certainties, tends to serve investors better over time. So how does all of this connect to real life and everyday decisions? For many people, precious metals are not about chasing quick profits. They are about diversification and long-term financial planning. Understanding why gold and silver are behaving the way they are right now can help you make more informed decisions about your own financial picture. Whether that means learning more before making any moves, reviewing how your existing portfolio is balanced, or simply having a clearer picture of what is happening in the broader economy that could eventually touch your savings, your retirement planning, or your sense of financial security. None of this is a suggestion to buy or sell anything specific. It is simply about giving you the tools to understand the moment so you can make your own decisions with a clearer head. To wrap this up, gold crossing $4,000 and silver holding firmly above $55 represents a genuinely significant moment in the precious metals market, one that reflects deeper concerns around currency stability, government debt, and global uncertainty. The fact that platinum and palladium are pulling back at the same time is not a contradiction. It is a reminder that different metals respond to different forces, with gold and silver currently more connected to monetary anxiety and PGMs more tied to industrial and automotive cycles. As always, the smartest approach is to stay curious, keep learning, and look at the full picture rather than reacting to any single headline. Thanks for spending this time with me today. If you found this helpful, remember to like, subscribe, and share it with someone who might benefit from understanding what is really happening in the gold and silver market right now. I'll see you in the next one.